I do believe gold will be a top performer. It might not be till late next year. Who knows? It depends how long this bear market phase lasts. 2008 one was a very quick correction. It was like an 8 month or so, somewhere in there, 10 month. So I think maybe by some point in 2025, gold will put in a bottom and then become one of the most exciting assets to be in, I think, to the upside, especially in the precious metal miner space. But when the stock market pulls back, gold is going to pull back also. Gold is only, I think going to move up just a little bit over the next 1 to 2 months as the stock market is cresting, about to put in a major top. So I think gold is going to be sideways, slightly higher for the next month and a half. After January, I do think almost everything is going to go down and the dollar will be one of the most conservative, safest plays that there is.
Technical analyst Chris Vermeulen, founder of the Technical Traders, sees alarming parallels between today's market conditions and those preceding the 2008 financial crisis. Vermeulen predicts a significant correction in both the stock market and gold prices, with the latter potentially facing a 15 to 20% pullback. The current market dynamics bear a striking resemblance to 2007's pre-crisis period. Multiple asset bubbles emerge simultaneously, from overvalued stocks to inflated real estate prices, amid growing global concerns. When the market eventually corrected, gold experienced a substantial 34% decline before its subsequent recovery. Today's market appears to be following a similar trajectory. After entering a bull market phase, gold temporarily paused while equity markets rallied, attracting increased investor interest in precious metals. Perhaps most notably, gold's recent outperformance relative to stocks could signal approaching market turbulence. Vermeulen anticipates that gold will ultimately emerge as a top-performing asset, though this transition may not materialize until late next year. He emphasizes that the timing largely depends on the duration of the current bear market phase. While his long-term outlook remains bullish, with gold projected to reach $5,000 or higher in the coming years, he sees limited upside potential in the precious metals sector in the immediate term. However, Vermeulen acknowledges that significant geopolitical events could dramatically alter this forecast. A major escalation in global conflicts, notably the outbreak of a full-scale war, could trigger a sudden surge in gold prices, bypassing the expected correction phase. For now, though, he maintains that the market will likely need to undergo a reset before substantial gains can materialize. Before diving in, subscribe, hit the bell icon for notifications, and share this video with your friends to help spread the word. Your support allows us to bring you more updates.
What I believe is going to happen is, I think we're going to go very similar to 2007. I think 2008, we're going to see gold pull back with the stock market. I believe we're at this point. Stock market is going to correct. We're going to see gold pull back 15, 20%. And then once the stock market has cleansed and gold's pulled back, I do believe gold will be a top performer. It might not be till late next year. Who knows? It depends how long this bear market phase lasts. The 2008 one was a very quick correction. It was like an 8 month or so, somewhere in there, 10 month. So I think maybe by some point in 2025, gold will put in a bottom and then become one of the most exciting assets to be in, I think, to the upside, especially in the precious metal miner space. But when the stock market pulls back, gold is going to pull back also. Gold is only, I think going to move up just a little bit over the next 1 to 2 months as the stock market is cresting, about to put in a major top. So I think gold is going to be sideways, slightly higher for the next month and a half. After January, I do think almost everything is going to go down and the dollar will be one of the most conservative, safest plays that there is. I think the stock market is going to try and claw its way up to the end of the year, might go a little bit higher into January. And then I think we're going to get into some big volatility. The stock market will start to be in this topping range. I think at that point, Bitcoin and gold, as the market starts to get nervous, I think Bitcoin and gold are going to want to continue to move higher while the stock market is kind of flatlining and potentially there's going to be a divergence. They're going to become a safe haven play for a short period of time. But once the market starts to break down and starts to break like a low and another low and a couple of these lows and there's panic, that's when we're going to start to see, Bitcoin and gold start to get pulled back. And then they're going to all move in sync together and they'll all start to correct. But there will be this sweet spot where Bitcoin and gold should continue to perform while the stock market is actually struggling. I really like the US to Canadian dollar. So I have all my investment account is in US dollars because I believe the US dollar is going to continue to rally. And based on the chart pattern of this and what's going on, I think oil's going to go down. When oil falls, we tend to see the Canadian dollar fall. It typically follows that commodity a little bit. So I think oil's going to collapse, making a weaker Canadian dollar. When we have chaos in the stock market in the world, we see the US dollar want to rally. So I think we're going to see this big play here. Based on this chart pattern, I think we could see about $1.70 to $1.73 exchange, which could be a record. I don't know how far it goes back if you've ever seen that, but there's like a 20% upside move just to hold the dollar currency in a brokerage account. You don't even need to put a position on. You can also buy, though, the dollar index ETF, which if you're already in US dollars, it gives you even more potential upside for it to take advantage of it. So I like this play. In 2022, when the stock market sold off, we saw the US dollar itself, US dollar index rally about 18%. If we look at this chart, you can see we had in 2022, chart doesn't quite, just pull this up here. 2022, we saw the US dollar just scream higher. And this was a play that we traded with an ETF. It moved up 18%. The biggest pullback, these pullbacks along the way, the biggest one for the year was only 4%, less than 4%. So that's what I like about currencies. And I believe we're starting another run higher in the US dollar. So to me, this is like a low volatility play. The crazier the world gets, the worse things get, the stronger the dollar should be. And it's a great way to take advantage of things. And if the dollar goes up, it's going to hurt. It's really going to hurt the economy. It's going to hurt multinational companies because now everything in US dollars is super expensive for other countries to buy. It's going to hurt commodities like gold. So this is just, I think, a part of that cycle, a cleansing event. And this is one of those low risk volatility plays that you can slide into and not have to like really panic about huge moves.
Chris Vermeulen forecasts a severe correction in the S&P 500, projecting a 35 to 55% pullback. Though the index may first reach new nominal highs, Vermeulen expects a flattening period followed by a downward break. His analysis indicates that 2025 will bring a series of bear flags, suggesting significant market unwinding. The S&P 500's 2025 outlook shows considerable volatility, with projections from 4,000 to 6,800. While the average analyst target is 6,679, Vermeulen maintains a more conservative year-end target of 4,800. His cautious stance is supported by several risk factors, including the index's top-heavy composition and concerns about overcrowded indexed investing positions. Vermeulen anticipates this correction could unfold over the next 1 to 2 years, though he remains uncertain whether it will mirror the sharp 2008 crash or follow a slower wave-like pattern like 2000. This bearish outlook contrasts sharply with many market strategists anticipating a strong 2025 performance. However, even among optimistic analysts, there's growing acknowledgement that some market turbulence lies ahead, with predictions of at least a 10% pullback in the S&P 500 during the coming year. Let's get back to the interview.
So I think January will be kind of like I think we'll start to see this market potentially go back up to these highs, maybe poke to nominal new highs. I do feel like we're going to start to see it eventually flatline. You know, you have a series of things moving up. Eventually, we're going to have a break to the downside, and it's going to start the downward trajectory. I'm not saying January is going to crash. I'm just saying January might be the top. We might see the highest high here. We might start to see it trade sideways. And then I think 2025 is like, okay, we're going to have a series of like bear flags and it's going to unwind. I do feel like we could see like a 35, 55% pullback in the SP 500 over the next year or two. I don't know if it's going to be like flash crash, like a 2008 where it's just a waterfall sell-off, or if it's going to be more like a 2000 3-year bear market, multiple big waves and bounces to the downside. We're not going to know, obviously, till that happens. The key is just being prepared and having an action plan to avoid or take advantage of it. So right now we've got this big divergence. We've got oil has been going down for the last couple of years. It's bouncing on support above a critical support level. All I think is we need Trump to get in, start drilling holes everywhere in North America. We need one piece of bad economic data. I think we're going to see oil fall out of bed, break down below this level and start a landslide towards about $45 a barrel. What the crazy part is investors are all heavily weighted, expecting World War III, and they're expecting huge oil pricing, and they've just been loading up on energy stocks, expecting this to go higher. And I think this is where there's this huge divergence. If oil breaks down and the economy goes weaker, there's a whole bunch of like pivot lows on this chart where we're going to see the energy sector stocks just collapse. I think we're going to see like a 40-50% haircut very easily in this sector, unwinding. And these purple lines across this chart. These are all dividends. This energy stocks pay huge dividends. But what I saw this happen back in 2008, you see energy stocks get absolutely clobbered. And not only that, but they start, when oil goes down, they stop making the big profits, and then they start cutting their dividends. And as they cut dividends, some of them stopped giving dividends, period. This could be like a big tipping point for the whole energy space to be out of favor for a year or two in a very big way. And, because these are dividend paying stocks, retirees are going to feel this the most because everybody buys the same stuff. The majority of the stock market money is like investors 50 years plus, which means they have a ton of money, they're close to retired, or they are retired, and they're all in the same thing: utility, blue chips, high dividend funds. And when they all panic, which is generally all at the same time, they sell off the same stocks and they crash. And I have this example here that shows this. This is the SP 500 at the top, and then this is the SPY high dividend fund. And as you can see, just like the Dow and just like the energy space, retirees holding the high dividend stocks are down almost 9 times more than if they just held the SP 500. They don't realize the risk they have in this sector. And another perfect example is during COVID. The top chart is the SP 500. COVID crashed 36%. Retirees just sitting there holding blue chips saying, hey, I got dividend stocks, I'll take my 4% yield and be happy with it. It'll help counter the losses. Well, they lost almost 50% of their money being in what they think is like the safest, easy, no-brainer investment. So, this is like a ticking time bomb for retirees. They all hold the same stuff. It's way more volatile than the stock market. They have all these misconceptions about what kind of risks their portfolios have. And I think things are going to get really ugly for retirees if they don't do something, because the energy space is about to get hammered. Dividends are about to get crashed, dividend stocks in general, and send things down. So this is like, I've been talking about this for a long time, but we're getting closer and closer. Eventually we're going to have that big financial reset, and it's either you're ready for it or it hits you and it'll be almost too late to do anything. A lot of people don't take action until it is kind of too late. They're already down 40-50%. Like, what do you do at that point? You've already done, the damage is done.
Gold is expected to face short-term volatility, potentially pulling back alongside the stock market as broader economic conditions shift. While some forecasts suggest modest gains soon, the real opportunity for gold may come after a market reset. In the longer term, gold could emerge as a top-performing asset, particularly in response to economic downturns or geopolitical tensions. As uncertainty lingers, gold remains a key asset to watch, with significant upside potential once current market corrections play out. What do you think? Will gold hit new highs in the coming years or face more turbulence first? Let me know in the comments below. If you found this video helpful, don't forget to like and subscribe for more market insights. Thanks for watching.